tax section. Good morning, tax section. My name is Andrea, and I will be presenting our presentation for today, moderating One Big Beautiful Bill Act. We're just giving it a moment to have the rest of the participants log in. Just wanted to give you some background information. Please do not forget to sign up for the upcoming presentation that's taking place in July and August, July 30th for Federal Tax Procedure Review, and that's part 1, and then August 20, Federal Tax Procedure Part 2. Our presentation for today will cover the major tax law changes introduced by the One Big Beautiful Bill Act. It's a sweeping $3.8 trillion reconciliation package recently signed into law by President Trump. This act includes significant reforms. All the attendees will gain insight into the practical implications of these provisions and planning considerations for businesses and investors. I will be presenting our speakers shortly. We will have Steve Hadjilogiou and Michael Bruno discuss the international tax provisions of the Act. Let me provide you with their bios shortly. So Michael Bruno focuses his practice on advising multinational companies, funds, and entrepreneurial families on sophisticated U.S. and international tax planning and transactions. He has written numerous articles on international tax planning and frequently submits comments on statutory and regulatory promulgations. As a strong proponent for pro bono legal services, Michael has founded the Transactional Equal Justice Program with Legal Services of Greater Miami, which offers free legal advice to nonprofits and low to moderate income small business owners, helping them launch a business. Steve focuses his practice on tax optimization of business operations and investments with a specific emphasis in the areas of international tax and real estate. Stephen also provides advice on international, inbound and outbound tax planning for multinational companies, family offices, private equity, and ultra-high net worth individual. He also advises funds, family offices, and ultra-high net worth individuals in connection with complex real estate structuring and investment issues, including in the areas of opportunity zone funds, 1031 transactions, and qualified small business stock. Next, we have Adam Smith and Mark Parthemer will cover the provisions that impact individual taxpayers, including estate, gift, and GST tax exemptions, income tax provisions, and the new charitable contribution rules, and increased tax on large endowments at large universities. Mark is Glenmede's Chief Wealth Strategist and Florida Regional Director. He is responsible for developing and communicating Glenmede's position and strategy concerning tax, estate planning, and fiduciary matters pertinent to clients and their advisors, as well as cultivating the growth and operations of Glenmede throughout Florida. And Adam is the founder of Business Tax Law, a tax business boutique law firm. He offers a wealth of diverse experience with past roles as an attorney at the IRS Office of Chief Counsel and the National Tax Department of a Big Four accounting firm, visiting assisting professor of tax law at the University of Florida, College of Law Graduate Tax Program, and an extern in the Securities and Exchange Commission Honors Law Program. We are about to start. I will like to let all of our attendees know that all of the material would be in the chat. And if you have any questions, to please type it in the chat. We will be monitoring the questions throughout the presentation, and we'll make sure that the speakers get the questions so that they can answer them adequately. I will also be typing in the CLE number throughout the chat. Please let us know if you have any questions at the end of the presentation. Enjoy today's presentation. All right, our first speakers are up.
Good morning, everyone. My name is Steve Hadjilogiou. Mike Bruno and I will be speaking about the international tax provisions and the opportunity zone rules that have been modified. Mike's starting to share the screen, so give it a second. So let's start from the beginning. The One Big Beautiful Bill, which might go down as the greatest named piece of legislation ever, was enacted on July 4 of 2025. Um, it's impacted numerous areas of the code, including income tax, estate and gift, investment structuring, and international provisions. There's immediate and long-term opportunities that we should be thinking about as we discuss these issues with our clients. Today, I know that Datan DeRote is in the audience, so I'm going to go very slow so everyone can understand, including him. Um, and we will start with the QF program. So the QF program was released in 2018 as part of the Cuts and Jobs Act. Um, I'm not going to go through all the details of how that program works. I think many of us have, over the past 8 years, spent quite a lot of time learning and operating in that area. Some of the key benefits of the program was that investors were able to invest capital gains that were earned and defer the tax bill that was owed on those capital gains. Under the original version of the program, those gains also got a 10 or 15% basis step up, depending on the timing of when the investment was made. Effectively, that 10 and 15% benefit was lost after investments made after 2021. The new program changes that a little bit in that any investment made after January 1 of 2027 will forever get a 10% basis step up as long as the investment is held for 5 years from the date the investment is made. So effectively, what the new law does is it changes the deferral. So under the current program, as you may know, the deferral ends on December 31 of 26. So if an investment is made this year in 25, a taxpayer only gets the deferral until December 31 of 26. So at this point, a year and a half. Whereas investments made after January 1 of 2027 will always get a 5-year benefit. And that new program that starts on January 1 of 2027 is permanent. So that benefit will always exist. There's also a new focus on what they call rural opportunity funds. And any investment in a rural opportunity fund gets a 30% basis step up so that the tax bill on the capital gain invested will be reduced by 30% and be due and owing after a 5-year hold. Also, for investments in rural areas, there's a lower threshold for substantial improvement on properties. The normal rule when you're outside of a rural area is that any existing structure, there needs to be 100% investment of additional capital into that structure to qualify for the substantial improvement test. For investments in rural zones, it only has to be 50%. The permanence of the new program is also something new. The current program was scheduled to expire on December 31 of 26, and thereafter it would go away forever. But now the big beautiful bill has created a system whereby that Opportunity Zone program will continue into perpetuity. The other big change is the geographic areas in which the qualified opportunity zones exist. There's a new system that redesignates land every 10 years. The first redesignation is going to happen in July of 26. So in July of 26, they're going to effectively announce a new map. and that map will set forth the areas in which the qualified opportunity zones can operate. Um, Even though that map will be set forth in July of 26, investments can't be made at that point in those new areas until January 1 of 27. And that redesignation of the map will happen every 10 years thereafter. So in July of 2036, there'll be a new map, 2046, and thereafter, there will be designating new maps. The remainder of the Opportunity Zone program has largely remained the same. That is, investors should typically invest their capital gain within 180 days. That investment should be invested into what's called a Qualified Opportunity Fund, which is typically a partnership or a C Corp or an S Corp. And then the Qualified Opportunity Fund would typically invest in an operating company, which is commonly referred to as the QOZB. The requirements of the QOZBs have not changed. The rules still remain the same. And so there's been no other significant changes to how a QOZB operates, with the sole exception of there is a whole new set of reporting obligations that will be required by QOZBs and QOFs beginning in 2027. If you're interested in how QOZBs operate, there is a series of articles I wrote. You could look up by my last name and find those articles. We also have an article out on the key changes enacted by the One Big Beautiful Bill. With that said, I'll turn it over to Mike to talk about the international side.
Great. Okay, so let's go ahead and kick off international. So before we get started, we thought we'd just go ahead and maybe prepare a slide that just discusses these rules very high level from a 10,000-foot overview, just international tax 101. So what I would just say is, number one, unlike structuring pure domestic investments, structuring investments in offshore entities as a U.S. person can be quite complicated. These entities come in various flavors. So flow through, am I invested in a, flow through entity like a Canadian ULC, LP, for example, or am I checking the box on a particular entity to make it flow through? Is my entity per se opaque? Is it a CFC? Is it a PFIC? Is it a non-CFC, non-PFIC? So understanding, what the classification of the entity is really key in terms of understanding what the tax treatment is. Secondly, I'd say one of the key points is just navigating the anti-deferral rules. So for US purposes, the two main regimes for international investments are controlled foreign companies and passive foreign investment companies. So CFCs and PFICs. Very generally speaking, a CFC is a foreign corp that's owned more than 50% by US shareholders. US shareholder being someone that owns at least 10% of the voter value of such foreign corp. And then a PFIC is a foreign corp with at least 50% passive assets or 75% passive income. The CFC regime in particular has undergone a number of changes as a result of OB3. The next point is, when structuring these investments, one of the things that we're really focused on is ensuring long-term capital gain treatment and qualified dividend income treatment. There's a lot of traps and obstacles to work through sometimes in order to get to those results. The next point is just ensuring foreign taxes are creditable against US taxes imposed. So if I'm paying, let's say, foreign corporate tax in a particular jurisdiction, I want to make sure that that tax is credible against my US tax obligation. And how do I do that? And then the next one is just minimizing tax and accounting complexities. Oftentimes it can get really expensive having all these international filing obligations, and in your deal docs, structuring information rights and disclosures. So how do we reduce that to the extent possible? So this is just sort of a roadmap of key considerations focused on, I'd say, outbound investment, which is really the main topic today. One of the provisions that didn't get picked up, which we were really focused on, was the proposed Section 899, the retaliatory tax that applies to non-residents that have various income and are located in discriminatory jurisdictions. That didn't wind up getting picked up. I'd say the large focus on the actual tax act that was enacted is more so on outbound investments. So let's talk through what's changed. All right, so the first one, so a CFC, I would say, has two flavors of income, possibly three. The first traditional one is called Subpart F income. That's the subpart of the Internal Revenue Code. High level, it's mostly passive income and certain related party income. That's traditionally been in the code since the 1960s. This new form of CFC income, known as GILTI, came out as a result of the 2017 Tax Cuts Jobs Act. And what that picks up is active business income. So prior to TCJA, if you had a CFC generating active business income, traditionally that income was not picked up under the CFC regime. The 2017 Act changed that, which now taxed active business income at what could be a favorable 10.5% rate. That rule was changed as a result of the new tax act. It received a new name as a result. And then also the deduction decreased a bit. So historically, corporate tax rate's 21%. GILTI, your active business income, for an eligible taxpayer attracted a deduction of 50%, which resulted in a 10.5% effective tax rate. And the magic number is that if you were paying over 13.125% of foreign tax, you'd have sufficient deduction and credit in order to not pay US tax. What they did is they reduced the deduction from 50% to 40%, which results in about a 12.6% effective tax rate. But in order to not be subject to the GILTI tax, provided you're paying at least 14% effective tax rate in the offshore jurisdiction, you likely do not have a GILTI deduction. There's obvious exceptions to that, but generally speaking, that's really the key number. On the second point, we have something called the FDII deduction, or FDII. And this also came out as part of tax reform in 2017. And what this refers to is if you're a USC corporation and you're exporting goods, services, potentially licensing to consumers outside the United States, you can potentially qualify for a reduced effective tax rate. So historically, rather than paying 21%, you can get an effective tax rate down to 13.125%. That was scheduled to increase a bit to about 16.1% at the end of this year. But what they did is they decided to go ahead and just reduce the deduction a bit to 33.3%, which results in effective tax rate of 14%, and it aligns with GILTI. Prior to, I would say, this change, there was a lot of, I would say, analysis in determining does it make more sense to be in a CFC and take advantage of the GILTI rate, or inbound all the operations, the IP, and potentially take advantage of the FDII rate. Now, what the new act does is it essentially aligns both of them to make it equivalent. One of the other points I'll just mention about FDII is in doing the calculation, tangible depreciable property was treated, I would say, negatively for FDII purposes. They wound up changing that. So to the extent you have a USC corporation that's providing, a number of goods or services outside the United States, as a result of the change to the technical rules, you might actually have a more increased FDII deduction. The next one is this thing called QBI exemption. So to the first point, this guilty deduction, what we're looking at is active business income, let's say, of the CFC. And in calculating that historically, what you would do is you would look at all of the net, tested income, the gross income, let's say, of the CFC offset by deductions and taxes. And then from that amount, what you would do is you would subtract 10% um, of the tangible depreciable property in the company. That's like a very high level kind of calculation. So if you were, let's say, a CFC that had, a hotel business or buildings where you had significant tangible depreciable property, um, you might have zero guilty income because that 10% of the tangible depreciable property could offset all of the income. And what they did now is they actually eliminated that, which is a pretty important change. So to the extent you're a CFC with I would say a high capital, tangible depreciable property type business, previously you might not have had a guilty tax, but now you could have a guilty tax. And where this is particularly problematic, I found already for clients, is where you're in a CFC in a foreign NOL position. So for US tax purposes, foreign NOLs are generally not taken into account. There's very, very limited exception. So you can be in a situation where you have a CFC that's not paying any tax because of a foreign NOL, and then historically, you relied on this favorable QBI exemption for not paying guilty tax. But now, because it's gone, you can have a guilty hit, and you don't have any foreign tax credits as a result of being in a foreign NOL position to offset it. So this is, I'd say, is a really important one to think about. The beat rate. So in 2017, we had this new provision come out, the base erosion anti-abuse tax. It really only applies to large taxpayers, at least 500 million of gross revenue. So for this audience, I'd say it's very unlikely that it captures a lot of the company and clients. But essentially, what it is it's a minimum tax on outbound payments from U.S. companies to foreign affiliates that are eroding the base. So, if the U.S. is making a payment of, let's say, interest expense, outbound, or royalties, which can create a deduction, provided that that's resulting in low taxed income. The BEAT basically imposes a minimum tax on that as a high level. So there was some change there. Foreign tax credit rules, I'd say overall, this was pretty favorable in nature. So a couple things that wound up changing. The first one on this guilty tax, so your active business income flavor of the CFC, um, historically under the TCJA, there was a 20% haircut on your foreign taxes. So if I'm paying, let's say, 20% tax in Spain, I couldn't get a full credit of the 20 on my active business income. Instead, I would only get 80% of it, so 16. What the new act does is it essentially reduces the haircut from 20% to 10%, allowing for more foreign taxes to be creditable with respect to guilty income. The next one is they made some changes to the types of expenses like R&E and interest expense that offset guilty, which can result in more favorable foreign tax credit treatment. There's this concept of a Section 78 gross up with respect to deemed foreign taxes paid. Um, that rule has been modified to but not no longer be taken into account, which is much more favorable. And then the last thing I would say is historically, when distributing, guilty, let's say, out of a CFC. So I wound up, making a Section 962 election with respect to my CFC's guilty income to be taxed more efficiently. I paid my corporate tax to the extent of any, and now I have this PTEP pool, essentially, my previously taxed earnings and profits. When distributing those out, some taxpayers took the position that those earnings when distributed, if it attracted a foreign dividend withholding tax, 100% of the tax is creditable. Now what the rules do is it makes clear that if you're distributing guilty PTAP, that 10% haircut also applies. The next one I'd say is a bit controversial of a change, although I'll say it was neutered down from various prior versions of the act, but it's this new excise tax on remittances. So the way this works is that if you're a U.S. person, let's say, that's making a transfer of cash to a family member, there's a potential 1% remittance tax that could apply, but it's very narrow in nature. So to the extent that the transfer is being made for certain financial institutions, so you have a bank account, or a savings account at a financial institution in the United States, this tax should not apply. To the extent you're making the transfer on a debit or credit card, this tax is not expected to apply. What this does go after is, U.S. persons, and that's a loaded term. That could be, a U.S. citizen. It could be somebody just living here, let's say, like not your traditional U.S. person tax definition. If you're making a transfer, let's say, from like a check cashing store or some type of, place that's not a financial institution, or you don't have access to a bank account, this is where this 1% tax could come in and apply to the amount that's being transferred for non-business reasons. So this is, I'd say, a very important one to look out. It's got limited application, but definitely relevant to a lot of individuals in the United States making outbound transfers. The next one, reinstatement of favorable CFC attribution rules and new Section 951B. So one of the most problematic, I'd say, provisions of the 2017 tax reform is they wound up eliminating what's called our downward attribution rules. So if you had, let's say, a foreign corporation that's owned by three siblings, a third, a third, a third, and one sibling's in the US and two siblings are outside the US, you would only have 33.3% US ownership. The other 66.6% is owned by non-US people. So going back, the definition of a CFC is more than 50% ownership by US shareholders. So in my fact pattern, you didn't satisfy the definition. What the 17 Act did, though, is they eliminated this favorable exception, which said that in my example, if, let's say, one of the non-US siblings owned an interest in a US partnership, under the attribution rules that apply to CFC ownership, they would attribute their one-third interest in the foreign corporation to that U.S. partnership. And now, because the U.S. partnership is deemed to own one-third of it, in addition to the one-third owned by the U.S. sibling, it's considered a CFC. So super problematic in a variety of contexts. So what the act does is it reinstates that favorable exception. So in my example, very unlikely for you to now have a CFC. But this new Section 951 Cap B is sort of a backstop to the original intention behind eliminating the favorable exception. And what this does is it polices a lot of situations where you have, let's say, a foreign parented multinational that has certain US subsidiaries with foreign ownership underneath. So think of like a foreign parented sandwich structure. This is what Section 951B can apply to. It can also apply to situations where you have US individuals that own interests in US C Corps and there's related parties. So I'd say overall very favorable that they've reinstated this. This new 951B is limited in nature, but it needs to be reviewed in the context of, I'd say, all your foreign structures. And I would say one major takeaway from this presentation is, if you're working with clients that are, US persons that have ownership of offshore companies, you definitely want to revisit those structures and reassess, is this company still a CFC? If it's no longer a CFC, could it now be a PFIC? Previously, you might have relied on the trumping rule in 1297E and 951C, which basically says that if you have a CFC and you have CFC income inclusions, the PFIC rules are turned off with respect to that particular year. But now, because of the repeal, if the company is no longer a CFC, now you have to worry about your potential PFIC issues. So definitely, I'd say a key highlight is revisiting those. And just to wrap up on the last three here, so there was some changes to, I'll call it our pro rata shareholder rule. So historically, if you owned a CFC, the general rule was is that it's the U.S. shareholder on the last day of the year that has a potential subpart F or guilty pickup. That rule has essentially been modified to require that, any applicable U.S. shareholder that owned a CFC during part of the year could have a potential CFC income inclusion. So this is I'd say a very important change, especially in the deal context, where you're selling CFCs across years. Consider making, a closing of the books elections or making other elections that can affect closing of the books. We do expect some potential favorable maybe elections coming out here that will make this a clean kill, I would say, in the transactional perspective, where you're moving a CFC from one U.S. shareholder to another U.S. shareholder. What else? I'd say two other important points. The Section 954C6 look-through rule that applies in the Subpart F context was extended and made permanently. This is one that was always subject to sunset, so we're glad that that one wound up getting modified. And then the last one, the TCJA made some changes to the inventory rules. So basically, to the extent you manufactured inventory abroad, all of it was considered foreign sourced. Now what they've done is they've modified the inventory sourcing rules a bit for inventory produced in the US that is then sold, let's say, through a foreign branch. It can allow, I think, up to 50% of that income to be considered foreign sourced for purposes of the foreign tax credit calculation. So what this can result in is better foreign tax credit treatment because you get more foreign sourced income. So to the extent you're paying foreign tax, it results in more potential creditable, utilizable tax. And just to tie it all together, these are just some highlights about what we already discussed with the guilty Q by beat. And just to kind of reiterate the point, to the extent you have, U.S. taxpayers that own businesses overseas, now this is the time to reassess the treatment of those overseas companies to see if these changes or the tax positions have been affected by the act, whether favorably or unfavorably. Steve, I don't know if you have anything else to add, but I think that's it from our end.
Okay.
Great. Thanks so much, everyone.
Thank you, Mike. Thank you, Steve. Hi, it's Mark Parthemer. Let me just share my screen as well. So I'm going to take the next section, and during this section, we're going to talk about the individual and charitable entity provisions. We're excited that we have Adam Smith joining us today. Adam is obviously, you heard his bio, he's quite the expert, and he's really going to help us understand the changes that were made and weren't made to 1202 QSBS. So we're going to save the best for last, and Adam will bring us home with that focus. So let's now go from the international and the QOZ through some of the individual and charity provisions. Now, typically when I talk about this, I talk a lot about, some of the factoids about this new act, over 870 pages, one amendment in the House, 492 were proposed in the Vote-A-Rama provisions in the Senate. The original short title, and Mike, you just really added to this for me today. I really appreciate it. So the original short title was the One Big Beautiful Bill. As enacted, it doesn't have a short title. The official title of this act is an act to provide for reconciliation pursuant to Title II of the current Congress Resolution 14. So What are we going to call it? The Big Beautiful Bill or the BBB? The thing that I cracked up about the BBB, just being a nerd on this sort of thing, is that's the same acronym that was Joe Biden's big plan, the Build Back Better Act. So what might we call this? The first time ever I've heard this, the OB3. Thank you, Mike Bruno. That was phenomenal. I like that. I might steal that. I'll be happy to give attribution. But recognize when the House put in the short title. Remember, this was done through reconciliation. So when it gets to the Senate, the parliamentarian strips everything extraneous to tax revenue and budget. And of course, title is extraneous. So similarly, we saw this in 2017, where the Tax Cut and Jobs Act was the title, the short title that the House gave the bill. But when it got to the Senate, that got removed from it, got sent back, and the House revoted for it without the title. We saw that again. We still call the 2017 Act the TCJA, so perhaps this will be our OB3. That said, let's start with transfer taxes. So what's happened? Where are we? What happened? And is it permanent or temporary? We're going to use that format for a number of these provisions over the next few minutes. We do know that we're 10 million indexed. It's going to 13,990. That is, no longer going to sunset. It's going to change starting next year. It will increase to 15 million. That will be slightly greater than what it would have been at the 10 million index. CPIU would not have brought 13,990 to 15. So we'll see an even greater enhancement, giving clients the opportunity to use this extra million and change in exemption, 2 million and change for a married couple. So that creates an opportunity. This is a permanent change, no longer a political football or something that we need to worry about a looming sunset as it relates to estate and gift tax exemption. Similarly, generation skipping transfer tax exemption it stays in lockstep. Right, we've seen over the years where it's separated out from the estate and gift tax exemption, but it's been in lockstep. It continues to be in lockstep. So starting next year, it too will increase from 13,990 to 15 million on a permanent basis and indexed starting in 2027. So that's really all that we saw as it relates to transfer taxes. It creates it gives some certainty, and it creates opportunity for additional gifting, particularly, perhaps using current techniques or leveraging exemption or valuation discounts, things of that nature. But I think we'll find that this gives some certainty to clients that will give them some peace of mind and create the platform from which we can do additional transfer tax planning. What about the income tax changes? Well, they were many and varied. Let's go over a bunch of those. So currently, we know that in the TCJA, we had the elimination of the 39.6 highest marginal federal individual income tax rate. We had an expansion of the brackets. We had a relaxation of AMT. Often like to talk about, in 2017, we had more than 5 million individuals paying alternative minimum tax. 2023, the last year for which we have numbers, less than 200,000. So the number of individuals captured by AMT has dropped dramatically. That's as a result of 2017 Act changes. Personal exemptions were eliminated. Standard deduction was almost doubled under the 2017 Tax Act. We had a cap on mortgage interest to the extent the debt was up to 750, but not on interest for debt beyond that. And we had the elimination of miscellaneous itemized deductions except for educator expenses. So what happened in the OB3? All of these were extended with only one modification. It was actually taxpayer enhancement. The increased standard deduction was further increased for this year, and it'll be indexed starting next year. All of these changes that you see in the current law that have been extended were extended on a permanent basis. Well, what about some new issues? And this one is one that's sort of going to trip up a number of our clients in a bunch of situations. Recall that the P's limitation, which for income tax purposes was a trimming of itemized deductions as income increased. Those were repealed in 2017 Tax Act, designed to sunset, come back in 2026. That repeal has been permanently extended. So starting with TCJA, we've had no overarching limitation on itemized deductions. Well, now we do. So if we look at number 2 going across, there is a maximum benefit of itemized deductions of 35%. Now, our current highest federal marginal income tax rate for individuals under this act is 37%. What this means is for individuals who are in the 37% income tax bracket, they will receive a 2/37 haircut on the value of their itemized deductions. So there'll be a mismatch between the deduction benefit and the marginal rate paid on income. So that is a big deal. What about charitable contributions? And actually, let's go over this first. So charitable contributions, going to our left column, the current. We had during COVID years, during the pandemic, we had an above the line deduction for non-itemizers who gave cash contributions to public charities. That was temporary and has gone away. We certainly don't have a floor for individuals. And we know that the TCJA increased the AGI cap, taxpayer friendly, increased the AGI cap to up to 60% of AGI would be the cap for cash contributions to public charities. So what's happened here? Well, a number of changes. First, for non-itemizers, we have a reinstatement of an above-the-line deduction for charitable contributions of $1,000 for individuals anyone filing individual filing singly. $2,000 for married filing jointly will be the above-the-line deduction, assuming that the taxpayer doesn't itemize. We're going to talk in a bit. That may seem nominal, but it's going to be huge for charities, and we'll get to that section in a bit. The second, we haven't had a floor. Now, if we look at 3B, we now have a floor on charitable contributions of 0.5% of your modified adjusted gross income. Only amounts in excess of that are deductible. The 60% limitation for AGI cap, the increased cap to 60%, also made permanent. And so these changes are designed to come in 2026. By the way, for corporations, let's go back to 3B. Although we see a 0.5% of modified AGI as our floor for charitable contributions for individuals, it's 1% for corporations. Historically, corporations have had a 10% ceiling, that is, charitable contributions are deductible up to 10% of their income. That is retained. So just for a moment, let's walk through a quick example, the difference between 2025 and 2026 for an individual on how this floor works. So imagine we have someone who's earning $200,000. That's their, let's call it their modified adjusted gross income. They make a cash donation of $1,500. What do they get to put on their Schedule A itemized deductions? Well, in 2025, we don't have the floor. So they get a $1,500 charitable contribution deduction on their Schedule A. Starting in 2026, there'll be a floor of 0.5%. 0.5% of $200,000 is $1,000. What this means is the 2026 charitable contribution deduction on Schedule A will be limited to $500. Now, there always seem to be nuances in the tax world, and there's a nuance as it relates to this as well. And that is, what happens if there is a charitable contribution carry forward? So an individual or corporation that makes such large contributions that they can't deduct them, they're in excess of the cap, so they get to carry it forward for 5 tax years. What happens to this floor? Is it lost, or was it simply suspended? And it's the latter, it was simply suspended. So looking at this hypothetical on our screen, if in 2026 this taxpayer was in a situation where their charitable contributions were so great that there was a carry forward, they would carry forward not just the amount that was unable to be taken, but they would also be able to carry forward that $1,000 floor. Now, in the successive years, the floor will continue to apply. So this isn't like a freebie or a way around it, but it is a way to recognize that that floor amount is simply suspended in the year. It is lost if the exemption, if the donations are fully able to be taken. If there's a carry forward, you get it back. Well, the SALT cap was a big political football. We certainly know that. What really ended up at the end of the day happening? We know we have a $10,000 limitation on the deductibility of state and local taxes. We know that that was set to expire at the end of 2025. We know that we have the PTETs and we have this pass-through entity workaround. What happened under the law? Well, one thing that's not on there that didn't happen is and certainly Steve and Mike and Adam and I were part of a delegation on behalf of the Florida Bar that in May went up to DC to meet with Joint Committee on Tax and House Ways and Means and the Senate Finance Committee. And we heard a lot in the hallways about perhaps the introduction of a sea salt, that is a corporate level state and local tax cap. That did not happen. So that was an interesting development. I thought for sure we would see something in that area. That didn't happen. What did happen? For starting this year, 2025, the cap was increased to $40,000. It's subject to a phase down. The phase down is not a phase out. A lot of times we will see where benefits phase out, and this is just, it is a phase down. It begins at $500,000 of income for both an individual filing jointly and an individual filing singly or married filing jointly. And that phase down starts at $500,000. By the time AGI gets to $600,000, the $40,000 cap is reduced down to $10,000. So that cap is simply reduced down, and that's why it's not phased out, it's phased down. Interesting, we use CPIU for indexing most things that are indexed in the code. Not the case for the state and local tax deduction cap. It will be adjusted as not just the 40,000, but the 500,000 to 600,000 phase down range by 1% starting next year, which means that the $40,000 limit this year will be $40,400 next year. The original bill in the House had a ban on the pass-through entity workaround. What came out of the Senate was not an elimination or a ban entirely on the workaround. So there may be still an instance where clients will find themselves in a position to continue to use what they might have put in place over the past 8 years. Now, many of the provisions we talked about so far, actually all of them that we've talked about so far, have been permanent. That's not the case for this one. This increases through 2029. And it reverts back to $10,000 in 2030. Now we're going to talk about some additional temporary provisions coming up next. All of those are through 2028. So this is a great thing to remember what Albert Einstein used to say about his phone number, and that is, he never bothered to memorize his phone number. Back in his day, we had something called a telephone book, and he said, if ever I needed it, it's in the book, I can look it up. It's important to know that there are a lot of nuances in our world, a lot of taxes, a lot of moving parts on effective dates and elimination dates. It's always good to have them in a manner where we can look them up. QBI, what happened with QBI? This was actually a permanent one. So the 199 Cap A has been retained. It's been enhanced in part in a couple of ways. If we look at the new law column here, the House bill originally proposed increasing the 20% to 23%. However, that was dropped by the Senate. So the current 20% is retained. The phase in for the limitations have been increased by 50%. So where do the limitations start to kick in for the SSTBs has gone up by 50%. So for non-joint filers, it went from 50,000 to 75,000 is the range now, starting at 197.3, and from 100 to 150,000 starting for married filing jointly at 394.6. The other change that was made to QBI, there is now a new minimum QBI of $400 that was introduced. So again, we have a look-through rule here for material participation, but this was a new provision which we hadn't seen before. This will be indexed starting in 2027. So the new changes come into effect in 2026, indexing in 2027. QSBS, we're going to defer. QOZs, we already heard about. Auto loan interest deduction. What happened here? So auto loan interest currently is not deductible. Under the new law starting this year, there is an above-the-line deduction for up to $10,000 of interest paid on loans for acquisition of certain vehicles. In short, we can think of those vehicles as U.S. made or final manufacturing process, U.S. made passenger vehicles. There is a phase out for this deduction. Phase out begins at $100,000 for single filers, $200,000 for married filing jointly. Again, that's effective this year, and it's temporary through 2028. What about no tax on tip income? Going into this law, we know that tip income was taxable. Now, we have an above-the-line deduction for up to $25,000 of cash tips received by a worker in an industry that customarily receives tips. The law did not define what industries customarily receive tips, but mandates that Treasury will have 90 days from the date of enactment to come up with that list. This will phase out, again, 150, 300, single, married. It's effective for 2025, but only temporarily through 2028. No tax on overtime pay. Currently, overtime pay is taxable. Under this new law, there's above-the-line deduction. $12,500 if you're single, $25,000 married filing jointly for qualified overtime pay. There's a couple of things we need to understand about this to make sure that we see how the reconciliation process squeezed the cost and how Congress was trying to look to trim and keep under control what they had to pay for to make things in this law be able to pass muster. Two things here. The first, it's only overtime pay under Section 7 of the FSLA. So all those who get overtime pay separate from that, who aren't under the gambit of Section 7, that doesn't count for them. And it's only on the overtime pay. So what does that mean? Let's say a worker customarily makes $20 an hour. And during their overtime, they're subject to Section 7 FSLA. That means they get time and a half, so they get $30 an hour for the overtime pay. The above-the-line deduction is for the overtime pay, that $10 an hour. So the $20 an hour of base pay is still taxable. It's only the overtime pay that might fit under this above-the-line deduction. It too is subject to a phase out, 150, 300. It's effective this year, and it's temporary through 2028. What about no tax on Social Security? Well, that didn't happen. Social Security benefits are potentially taxable, as we know, based on other income. As your income goes up, zero Social Security benefits taxable to 30 to 50%. Well, that wasn't changed. I know that was one of the campaign promises, but it didn't happen. But in lieu of that, there is a new standard deduction for those over age 64. This increased standard deduction is on top of the now doubled standard deduction. And so the extra $6,000 for those 65 and older could serve as an offset or in lieu of the tax on Social Security benefits. There's a pretty low phase out for this. It starts at $75,000 for individual, $150 married filing joint. So when we think about clients who are, I guess one of the things I would hearken on here is, given all of these phase outs and phase downs on the SALT cap, overtime pay, Social Security benefits, things of this nature, everything else our clients look to do has an enhanced ripple effect on their tax return, right? So a client has a traditional IRA, wants to, do a conversion to a Roth. Well, that's going to spike AGI. That means that there can be a whole lot of other consequences. It used to be just Medicare premium and taxation of Social Security. Now it's also the standard deduction and the SALT cap and a number of other aspects. So there's a heightened need for clients to put pencil to paper and do the pro forma tax return before they engage in a transaction that's going to affect their income. And I think that's just something that we're going to have to remind clients of now and going forward. HSA and 529 plan. So the HSA, the House bill expanded the category of qualified expenses, including things all the way through gym memberships. Well, the Senate dropped it. So no change to the HSA. What about 529 plans? Well, these continue to see a relaxation or the expansion of the ability to be used in a manner for qualified expenses. In this case, we're seeing an expansion. So originally 529 plans were designed to help save for college. And then we saw this exception. We've seen other changes, like on the renaming of a beneficiary is no longer a taxable event, that sort of thing. But now we saw there was an ability to pay for certain expenses for elementary, well, basically K through 12, of up to $10,000. What we find now is two things happened here. The up to amount has been increased from $10,000 to $20,000. In addition, the qualified expenditures were expanded from tuition to now covering curriculum costs, books, online costs, tutoring, the standardized tests, anything like an SAT, ACT, or AP test, right? Those, if there's expenses incurred those are now qualified expenses, therapies for students with disabilities, and any post-secondary credential programs. These are now includable expenses up to the $20,000 distribution limit under 529s, starting not this year, but next year. These changes were also made permanent. The infamous Trump accounts. And believe it or not, this money accounts for growth and advancements, aka Trump accounts, those are the official names that are in the law. They are actually called Trump accounts in the law. So what are these? This is yet another form of deferred income account that is available on an opt-in basis, starting 1 year from the date of enactment. Starting next July 4th, a minor or someone on behalf of a minor can elect into establishing a MAGA or Trump account. Well, how's the funding work? For individuals born this year through 2028, the government will seed that account with $1,000. Employers of the account owner or the parent of the account owner can contribute $2,500 a year into these accounts. $5,000 of transfers can be made into these accounts. It'll be indexed starting in 2028. Now, this is on the aggregate. So if mom and dad put $4,000 into their child's account, the grandparents can only put $1,000 in. during that calendar year or wait until the following year. There's no limit on contributions for exempt organizations. So, other thing we need to know about these accounts, focus on this. These are really, really for minors. So, no contributions can be permitted once the beneficiary has attained 18. So, the last contribution is the year in which the minor turned age 17. That's our final year in which money can be stuffed into these accounts. Let's skip down for a second to distributions. Under 18, no distributions can come out of these accounts. Once the account owner is age 18 or older, distributions come out. However, they will be treated as a traditional IRA. In other words, there will be ordinary income and there's the potential for a 10% early withdrawal penalty. So what is that 10% penalty? That's for an early withdrawal from an IRA. There are 23, count them, 23 exceptions to the 10% penalty. One of the ones we are most familiar with is the 59 and a half age. If you're 59 and a half or older than that, you can take withdrawals, not have to pay the 10% penalty. Some of the other exceptions are tuition costs to a degree and deposit, partial deposit on first-time home purchase. I suspect a number of these accounts might be withdrawn for those uses. Now, what happens to the money in these accounts? It's not like a 529 where there's a master investment platform. Here, the investments, the money in there can be invested, but subject to limitations. What are those limitations? It's limited to a mutual fund or ETF that tracks an established U.S. Equity index. So there's three real aspects here that we focus on. One, it follows a U.S. index. So a mutual fund or ETF like an S&P 500, so SPDR or something like that. It cannot have leverage. So it can't be one of those funds that looks to enhance performance through leverage. And third, it cannot have fees or expenses greater than 10 bips. So the annual cost of these will be kept very low. Now, one of the things I think we need to think about is, unlike, say, 2503 or some other things, what is the gift tax consequence of a contribution into one of these accounts? Note that. Let's say a parent has a 5-year-old, once they make a gift into the 5-year-old's account of $5,000. Is that going to qualify for the annual exclusion? Well, we know the annual exclusion this year, it's $10,000 index for inflation. It's $19,000 per donor, per donee of a gift of a present interest. Well, if the account owner is 5, we've already heard you can't touch it until you're 18, certainly not a present interest. So the law provision doesn't address this. So there may in fact be a gift tax element, use of the exemption on the funding of these accounts. So let's talk a little bit about some of the, this is the most recent, some of the impact on charitable contributions and this new tax law. So typically in the US, there's over $550 billion that's donated each year to charities. The bulk of that comes from individuals, some from foundations, then bequests and corporations. These numbers are down on a year-over-year basis. 2023 is the last number we've seen, but it's a pretty big number. And so what are the impact of the tax law on donations? So if we think about some of the relevant changes that have occurred here, our standard deduction has doubled. What does that mean? It means a number of individuals who used to itemize no longer itemize. So they don't get a benefit for their charitable contribution. The estate tax exemption is increased. So a lot of folks who might have infused some philanthropy into their estate plan in order to avoid or reduce estate tax, less of a need. The corporate income tax rate It was reduced in 2017 to 21%, and that's permanent. So there's less of a pressure on corporations. We've also had some other changes. Now we have this new above the line deduction reinstated, the 1,000 or 2,000. We have this floor that we've talked about, the 0.5% of MAGI or 1% for corporations, and this maximum benefit cap. So does this impact taxpayers? Well, it does, and that impact on taxpayers is a massive impact on charities. So in 2018, so the first year of the almost doubled standard deduction, which has been increased yet again this year, what happened? Charities received more than $20 billion less in contributions from individuals in 2018 versus 2017. Over 23 million taxpayers switched to the standard deduction from itemizing, going from 2017 to 2018. And on average, those 23 million taxpayers were giving about $880 a year. And now they're giving about $880 a year less. That seems like a very nominal amount, $880, but $23,880,000 is over $20 billion. And so the reinstatement of the above the line deduction of 1,000, 2,000, could really have an impact on lessening the consequences that occurred as a result of the increase of the standard deduction. And of course, high net worth individuals are less tax driven to donate because of the reduced taxes. Companies have also behaved a little differently, right? When the tax rate went down, less donations by corporations, and focusing on other things. Now, more donors, how are they managing this? And so you have, of those 23 million, you have a lot of individuals who are still philanthropic. And so they're bunching. What does that mean? That means instead of giving $880 a year every year to their charities, they're saying, well, maybe this year what I'll do is I will give 3 or 4 or 5 years worth, and I will itemize. And then in the next 3 or 4 or 5 years, I won't give any. And so that has an impact on the recipient, right? Because the funds are now being received lumpy versus steadily. But that is a way individuals are saying, I'm going to manage the income tax consequences of not being able to itemize for some of this. The above the line deduction may mute the impact for some taxpayers, but as it relates to larger donors, I think bunching is still going to continue to be a pretty significant feature. What about the endowment investment income tax? So in 2017, to help pay for the Tax Cut and Jobs Act, we had the imposition for the first time of an endowment investment tax on large universities. Now, that tax was 1.4% on large endowments at large universities. Large endowments were those defined in the 2017 Tax Act as over $500,000 per student, and large universities were those defined as having 500 or more full-time tuition-paying students. There was an original House bill that was going to increase the tax rate all the way up to the corporate level tax rate of 21%. That's not what got enacted. The blue shaded column is what was enacted. But first, look at the heading here. The definition of large university was now increased from more than 500 full-time tuition-paying students to 3,000. There's a lot of smaller colleges and universities that are now outside the impact of this endowment tax because of their enrollment being less than 3,000. For those who have 3,000 or more students with an average endowment size of 500,000 to 750, the tax rate is unchanged. Those with greater than 750 up to $2 million per student, the tax rate increased from 1.4 to 4%. And for those over $2 million, the rate is now 8%. Here is an example of a number of the institutions based on the Nakubo study of the endowment per student size: Princeton, Yale, MIT, Stanford, Harvard. These are some with the largest per student size endowment. You can see in the second column, the averages here per student ranging from 4.5 to 2 million. And so if I go back a slide, you will see all of these, for example, fall in this last category, and so subject to what will be an 8% tax rate. What does that look like? So for example, Harvard with a drawdown of about 2.4 billion and an estimated investment earnings, which is based on studies. They're earning, based on their $53 billion plus endowment, about a little less than $6 billion in income. The current tax at 1.4% is $83 million. Under the original House bill that did not get passed, their rate would have gone to 21%. The tax would have been 1.25 billion, an increase of over $1 billion of tax. Under the version as enacted, the rate didn't go to 21%, it went to 8%. So the tax will be around 477 million. It's still a meaningful increase in tax of almost $400 million over what they're currently paying. And so that's going to have an impact. Clearly, that impact is compounded if the withdrawals are not just to replace the $400 million, but then also to pay that tax. So this can have a very interesting and impactful result for those subjected to now a rate not just of 1.4, but perhaps all the way up to 8%. The private foundation investment income tax, right? There was an excise tax that was proposed of up to 10% on private foundations. That, while in the House bill, did not make it in the Senate, wasn't in the final bill, and so it has not been passed. So with that, Adam, I am going to take pause and stop sharing, and I thank you for your attention and turn it over to Adam.
All right, thanks so much, Mark. Let me just pull these slides up for you, everyone. Let's see. And I will share my screen. Hopefully everybody can see it. Okay, and I will mention that Mark didn't get a shout out, but he should. He's a sponsor of the tax section with Glenmede, and we always appreciate their contributions, especially here. And also thank you for the nice introduction as well. So Mark got into a lot of detail on some of the individual income tax and estate and gift tax applications of the new OB3. I'll take Mike on that one too. I really like that. So one of the biggest benefits, and this is something when we were up on the Hill discussing with Senate Finance and House Ways and Means and Joint Committee of Taxation, this was something that we spent a lot of time on. Trevor Johnson was there with me, as well as Paul Lee and a few others presented on this, and happy to report that many of the requests that we made did make it in fact, made it into the bill. We did get a reply from the head of Senate Finance letting us know that our insight was helpful in pushing that through. So with that, I'm going to head into the 1202 area. And again, we've got some really great benefits here that we'll talk about. Some things that didn't get in. So what I'll talk about, we've got about 45 minutes. Try not to take the full 45, but we'll leave some time for questions. But we'll start with the background of Section 1202, some relevant terminology, taxpayer qualification requirements, and business qualification requirements. So when we get into the background, what you need to understand about 1202, if you haven't worked in the space, is that there are shareholder level requirements, and then there are also business level requirements. We'll address each of those. And we'll talk about the two basic 1202 planning techniques, and then get into the OB3 changes and how that might affect your planning and benefit your clients. Okay, so background, I just actually pulled up some information I had here. Hold on, let me see. So there was some information online that the Joint Committee on Taxation had put out. About $6.5 billion of that tax benefit had been claimed from 2022 to 2026 on QSBS alone. And then Treasury expects another approximately $1.3 to $1.5 billion of revenue or tax benefit claimed 2023, 2024. That's the amount of capital gain that was excluded. So this is a pretty big deal. I have a ton of clients. A lot of my practice actually focuses on this more recently because I represent a lot of startups. Let's go through the history a little bit so you can get an understanding of where we've been, where it originated, and how things have kind of changed over time. And then we'll get into where we are now. So the original law was enacted under the Clinton administration in 1993. It was part of the Revenue Reconciliation Act of 1993. And basically, the idea was Congress wanted to encourage long-term investments in small businesses, particularly in the venture capital and angel investor and startup space. And so what they did was they created this tax benefit where you would get a 50% exclusion from your gain on the sale of stock if it was qualified small business stock. And it imposed a per issuer limitation that limited that gain exclusion to the greater of $10 million or 10 times your basis. And we'll talk a little bit more about each of these requirements because basis may not be what you think or what you conventionally understand as basis from an income tax perspective. So from that period, from August 10th, 1993 to February 17th, 2009, those rules were in effect. And I know Mark mentioned some AMT aspects of the bill, and this is another aspect of a change in 1202. So it's worth noting that back then, the gain exclusion, the excluded portion, one, was treated as an AMT preference item, and two, was subject to a special rate, the 28% rate in Section 1 of the code. It wasn't your typical long-term capital gain rate. And then, again, back then, there was a reduction in the long-term capital gain rate down to 15% in 2003, which lasted until 2009, which made QSBS less appealing. And it's really important to understand this because when you meet with clients and speak with clients, one of the big parts of the conversation is there's not a great body of law out there on QSBS. The main reason is that it really wasn't a beneficial provision until very recently, mostly until 2017, 2018, when the TCJA came into effect and reduced the corporate income tax rate down to 21%. We'll talk a little bit about that. So back then in February 18th of 2009, Congress enacted the American Recovery and Reinvestment Act of 2009, which was a response to the 2008 financial crisis. If you live down here, you certainly understand what happened as a result of that. But as part of the package to stimulate the economy in light of the 2008-09 economic downturn, Congress increased the benefit from 50% to 75%. So now if you had $100,000 QSBS gain, now you would get $775,000 of gain exclusion. The other 25 remains subject to that 28% rate. Then in 2010, the gain exclusion went up from the 75% to 100% gain exclusion. So that was any stock issued after September 27th, 2010, and before January 1st, 2012. Another important change that came into effect back then was the elimination of the AMT preference item. So now, instead of being subject to the AMT, that additional gain, that non-excluded portion of gain, or the excluded portion of gain, rather, became not subject to AMT, whereas before it was subject to AMT. So you got a better benefit. Then in 2015, in December 18, 2015, we had the PATH Act, which extended that 100% gain exclusion, and the elimination of the AMT preference item became permanent for QSBS acquired after September 27, 2010. So we've been talking about permanence versus temporary changes. And back in 2010, it was a temporary change. The PATH Act extended that and made it permanent. Then, of course, we had the TCJA, which reduced the federal income tax rate on C corporations down from 35% to 21%, which makes a huge deal here because, as we'll see, you need to have a C corporation in order to qualify for QSBS gain exclusion. And now, effective July 4th, 2025, for any stock issued after that date, not on that date, but after that date, the OB3 enacted the Senate version of the reconciliation package, which was originally released in June. And that's the package that we've been speaking about today. So where are we with QSBS? This kind of summarizes everything, but we went again in 93 from a 50% exclusion to 2009 up to a 75% exclusion, and then beginning in 2010, 100% exclusion. We'll get into what happened with the OB3, but effectively, we end up with a phase-in of the exclusion, whereas instead of having a cliff effect that you needed to hold stock for 5 years to qualify, and this was something that we really pushed for when we went up there as a tax section, is now we have a 3-year, 4-year, and 5-year rule, with the 3-year giving you a 50% benefit, a 4-year hold giving you a 75% benefit. And if you hold for 5 years or more, you have the same 100% benefit. And then here are some notes about some of the other benefits that we're going to go through a little bit later. But there was previously the $10 million or 10 times basis rule. That's now going to be $15 million. And there was a gross asset test. So to qualify as a qualified small business, it used to be a $15 million gross asset test. That has been increased to $75 million. And then there's some provisions in there that address how you deal with stock that had been issued previously in a transaction to which tacking applies. That's section 1223. So those principles come into play under the new rules. Oh, here's the slide. Okay, so here's your for fiscal year 2022 through 26, it was about 6.5 billion. They call it foregone tax revenue. That's actually tax benefit for your clients if you were advising on QSBS. And here are those other numbers that I spoke of before, the 1.3 billion and the 1.5 billion for 23 and 2024. I just thought those were interesting statistics. Okay. Understanding QSBS, because I know a lot of folks who are on this call don't necessarily deal with QSBS on a regular basis. So as we get into the rules, it's helpful to understand what the terminology is. So section 1202, excluded gain. This is the portion of capital gain from the sale of stock that is QSBS, that is excluded from gross income under the applicable exclusion percentage. So remember, now we have a 50%, 75%, and 100% rule. This definition becomes important again, whereas under the TCJA and post 2010, really, we had 100% gain exclusion. So there was no non-excluded portion of the gain. Section 1202 gain, that's a type of gain that's defined in Section 1H7. If you remember, Section 1 deals with all these different types of gains. So you have your 1231, net 1231 gain. That's, what rate that's taxed at, which is the long-term capital gain rate. You have the long-term capital gain rate. You have the ordinary income rate, and you have special rates that apply to other types of gain. Here, Section 1202 gain is subject to that 28% rate. So typical long-term capital gain, 20% maximum rate. 1202 gain is going to be a 28% rate. And always remember that there's a potential 3.8% net investment income tax on the sale of a passive type of asset. Here's just a basic example. When the gain was 50%, you had $1 million gain, $500,000 excluded. So your excluded portion of the gain is $500,000. That other $500,000 would have been taxed at the 28%. And we know now that under the new rules, if you held for 3 years, that 50% gain exclusion benefit would apply. And so the remaining $500,000 now would be subject to that 28%. Non-Section 1202 gain is capital gain realized on the sale or exchange of QSBS that does not qualify for the gain exclusion. So here's an example. We'll get into it a little bit more with the strategies, but if you contribute property with built-in gain to get your stock in your C corporation, for example, when you do a conversion of a partnership, an LLC taxes a partnership to a C corporation in order to qualify for 1202, that pre-contribution appreciation is not Section 1202 gain. It is not subject to the benefit. So if you form a company with minimal capital and grow the business to a value of business assets of $100,000 and then convert to a C corporation, you would basically pay tax on that first $100,000 of gain pre-conversion. That's going to be taxed at the regular capital gain rate, not the 28% rate. So that's at your 20% plus the 3.8% net investment income tax rate. All right. So as I said before, there are both corporate level qualifications and taxpayer level qualifications for Section 1202 to apply. What are the taxpayer level qualifications? First of all, the shareholder has to be a non-corporate taxpayer. It cannot be another C corporation. There are some rules about how subsidiaries work. We can talk a little bit about that, but generally it has to be an individual, a trust, a state, or specific types of pass-through entities that are permissible under a pass-through entity rule in 1202G. The way that works, the pass-through rule works, is if you hold an interest in a pass-through entity at the time that the pass-through entity acquires QSBS, you're entitled to the QSBS gain exclusion when the pass-through entity sells that QSBS equal to your portion that you held when the company acquired the QSBS. So this comes up sometimes where after the pass-through entity, say a partnership, an LLC taxes a partnership, acquires the shares and then brings in a new partner, that new partner would not be eligible for the QSBS gain exclusion when the partnership sells the QSBS. And again, so the limitations are based on the proportionate share that you own in the pass-through entity when the QSBS is purchased. The holding period requirement is a per issuer limitation. It's applied against the eligible gains, and under the TCG, the pre OB3 rules, it was a strict 5-year holding period requirement. Some issues that came up with this were that we pushed for some guidance on, and there's another proposal out there that not a lot of these some of the ideas in the bill actually came from it. It was from Congressman Kustov, was to permit certain convertible instruments or hybrid instruments to start a holding period when you receive them. And the biggest ones here were the SAFE notes and the KISS notes. Those are really so SAFE are simple agreements for future equity, and KISS investments are similar types of investment vehicles, and they're commonly found in angel investor type areas or early stage startups. And what it is it gives you a contractual right to convert to stock on the occurrence of a new financing round or some other event with some sort of value hurdle set. What happens if you have an 83B election? If you receive stock in exchange for services, you can make an 83B election. That 83B election will allow you to start your holding period. So that is made clear. And then there are certain permissible transfers where you can tack holding periods. And those examples are gift, death, or partnership interest, distributing the QSBS to a partner. And what I will say here is you got to be really careful, because if a partner acquires QSBS and contributes it to the partnership, the rule is very clear that you lose QSBS status when you make that contribution. Okay, so you got your non-corporate taxpayer, your holding period requirement, which was 5 years. And then the biggest one here is the original issuance requirement, which refers to stock that's issued directly from the corporation, meaning a secondary purchase. If I start a qualified small business and I form the company and I have the company issue stock, and Mark sees how well my company is doing and he says, I'd really like to get in. Can I purchase 50% of your interest from you? And I say, okay, you can buy my shares. And Mark buys the shares from me and I take the money. What he just purchased is not QSBS. If, however, we use Mark's money to fund the growth of the business and he makes a contribution of cash to the corporation and the corporation issues the stock, that is an original issuance. And so the original issuance requirement is really important to understand, and you need to know how it operates and what types of transactions will bust that requirement. One of them, as an example, was a distribution from a partnership to the partner. The entity has to satisfy the qualified small business definition at the time of issuance. So that's another requirement. The fourth requirement here is that there are no significant redemptions. There are a number of different types of redemption transactions that could disqualify all stock issued either within a year before or after a 2-year window. So that's redemptions from any shareholder. That's the second one. Or within a 4-year window starting 2 years before the date of issuance of stock and ending 2 years after the date of issuance. And so basically what you need to know is if the redemption comes out, if you see a redemption transaction in the history of a corporation, you need to be wary of any issuances of stock that occurred within, I would say, 2 years and certainly 4 years of that redemption transaction, and make sure that the redemption was not of a value that exceeded, in the case of the 2-year window, 5% of the aggregate value of all the stock of that shareholder at the date of the redemption, which is a pretty low threshold. And then there's also a de minimis exception. So we do see this come up quite often, but you need to make sure that you don't blow this requirement. There are some really good exceptions here that I've been able to use to get into. Certain redemptions are disregarded if it's in connection with the termination of services, death, disability, mental incompetence, or divorce. And in the regulations for 1202, there's also a mention of termination of services from an independent contractor, though that section is reserved on. So there are some exceptions to redeem out a service provider owner. What are the business level qualifications? So as I mentioned before, it has to be a C corporation. It has to be a domestic C corporation. We talked about international. Domestic means U.S., organized under the laws of a state in the United States. Currently, S corporations and other types of business entities do not qualify. So if you sell stock of an S corporation, or if you sell an interest in an LLC that's taxed as a partnership, you cannot claim QSBS on that sale. And that's true when we talk about there are different types of structures with pass-through entities. You have to have the pass-through entity sell the stock of the underlying corporation to qualify. What's a qualified small business? This is 1202D. As of the issuance date, for it to be a qualified small business, you must meet the aggregate gross asset test. Up until July 4th, 2025, that threshold was $50 million. The new law changed the threshold from 50 million to 75 million. So now larger businesses can qualify. That was absolutely something that we proposed and promoted on the Hill. We have a lot of clients who are in that realm. And the problem is that the original bill, which came into effect in 93, had never been adjusted for inflation. So what we now have is an increased number to 75 million, which is going to be subject to inflation adjustments. Aggregate gross assets, what does that mean? I said before that it's not your typical tax definition where it's your cost or other basis under 1012. When you contribute property, it is the basis unless you've had contributed property, in which case it's the fair market value on the date of the contribution. That's really important because we're going to talk about some of the planning techniques in a minute. And one of the big planning techniques focuses on this fair market value determination and the use of the fair market value in determining what your basis is, not just for this purpose, but also for the 10 times basis gain limitation rule. So remember, the gain exclusion is limited to the greater of 10 million, now 15 million of gain, or 10 times your adjusted basis. Reporting requirement. So in 1202, there is a grant of it's actually an instruction that Treasury is supposed to issue regulations on the reporting requirements for Section 1202. Those have never been promulgated, and so sort of a wait and see approach there. But as of now, there's nothing in the regulations requiring such reporting. There's an aggregation rule, so all corporations that are members of the same parent subsidiary control group are treated as a single corporation for purposes of these tests on whether you aggregate your assets. The active trader business requirement, this is another really important requirement. So the rule says during substantially all of the taxpayers' holding period, the issuing corporation must meet the active business requirement and must be a C corporation. So what does substantially all mean? Some of us who operate in the corporate M&A space understand that there's a revenue procedure out there that says, for purposes of reorgs, it's 70%, or you can get a ruling that says it's 70%. But for us, we really don't know, although a lot of practitioners believe it's 80% of the holding period. So what does that mean? Let's go under the old rule, 5-year holding period requirement. You start a company in years 1 through 3, you have a ton of passive assets and you're not really actively operating. Okay. And then in year 4 and 5, you take those assets and you sell, liquidate, or invest them into what becomes an active trader business. Arguably, you have not held the assets that are active for substantially all your holding period and use those assets in an active trader business. And so if you were to try to take a QSBS position, it is quite likely that the government will come back and say, what you have is not qualified small business stock. Now, a lot of times I have clients ask me, hey, can you take a look at my business? Is it going to qualify? And my answer is always the same thing when it's sort of gray at the moment in their early stage startup, and maybe they're doing some activities that don't qualify. We need to make sure, and we need to plan as time goes on, that you are holding at least 80% of your assets and using them in an active conduct of a qualified trader business. We talked about the eligible corporation has to be a C corporation and the 80% test. There are a ton of different rules. One that I'll highlight here is startup research and working capital. There's an exception in the rule for the first 2 years of operation that those are not treated as passive assets so long as you're using them to fund the startup of a qualified trader business. And the other thing that I'll mention there, because we're going to get into it with a change in the OB3, is that with the change in Section 174, the requirement to what was a requirement to capitalize research and experimentation costs, that increased the basis of your assets and made it more likely that early stage tech startups wouldn't qualify, because if you invested more than $50 million in that, well, you've blown your aggregate gross asset test. All right, so the planning techniques, I alluded to these before. The big two are what we call stacking and packing. Stacking, as we said before, Section 1202 applies, the limitation applies on a per taxpayer basis. So the idea is if you can create another taxpayer for income tax purposes, then that other taxpayer is also entitled to the greater of $10 million or 10 times their basis limitation on the sale of QSBS. What's a good example of that? Non-grantor trusts. We use those a lot. And so if you can create separate taxpayers, and I know Mark does a lot of this work, and a lot of our estate planners do a lot of this work, you can create what they call 1202 stacking trusts, and you can compound a benefit. Let's say you only had one taxpayer and he has 3 kids. You create 3 non-grantor trusts for the benefit of each of the kids. You've now, let's say he was in the $10 million rule, not the 10 times basis rule. You've now compounded a gain exclusion that would have only been $10 million to $40 million. And now it's 15 million post act. And so you can really use this rule to your benefit. There's no right now limitation on the ability to stack trusts. So some people believe, as much as your heart desires. I play by the rule of pigs get fat, hogs get slaughtered. Don't try to get too aggressive with this. And I will also note that while we were on the Hill, the questions that came from Senate Finance, JCT, and House Ways and Means to us back on this issue made clear that they are aware of it, and we may see some action in this area. They know that it is an area that is sort of ripe for abuse and has been abused by taxpayers. So just keep an eye on it. But right now, the thinking is you can make gifts, because gifts are permitted, to non-grantor trusts, to create a separate taxpayer and benefit from a compounded gain exclusion. One other thing here, I'll give another war story on this, is, if you're pregnant with gain, if you're under letter of intent or you're about to sell your business, I had one who called me 2 weeks before the closing date. Hey, I want to set up a bunch of non-grantor trusts. I've already had them drawn up by the estate planner, and the estate planner told me this would work, no problem. There is something called the assignment of income doctrine for those of you who went to tax school. And that doctrine would allow the government to question or to disqualify the transfer and force you to be treated as having recognized the income if you transfer. Packing. So packing refers to, this is the second technique. This is really taking advantage of the 10 times basis exclusion limit. And what you're trying to do here is you wait as your company grows until the fair market value of your assets is above what used to be 1 million, and now with the $15 million mark, it would be 1.5 million, so that you get into this world of 10 times your basis. So 10 times $1 million is $10 million, which is the other number in the greater of test. That's how I get to the $1 million of basis. So if your share in the underlying assets is above that 1 million pre-OB3, then you would wait until the value of the assets, your share of that value, was more than $1 million. And then you pull the trigger to convert to a C corporation, and you're in the 10 times basis limitation rule, right? So we do this a number of ways. It really depends on how the corporation or the entity is originally organized, whether it is an LLC, taxed as a partnership, in which case you can file an 8832, check the box and make it a C corporation. That is a deemed liquidation of the partnership and a deemed 351 formation, right? And so you would get a fair market value for 1202 purposes, a fair market value basis in the assets, and you could take advantage of this packing strategy. The other situation for planning into this is where you have an S corporation. And in that case, what you do have to do is you can't just revoke your S election. There's a series of transactions that you have to go through to form a new C corporation and issue new stock to the S corporation. I won't get into the details there, the technical details, but I've seen a host of problems where corporate lawyers have tried to set up clients, and lo and behold, 5 years later, they sell it for $100 million gain, and there was a problem with the setup because they didn't do a proper transaction to issue stock from a C corporation. That's really getting into that original issuance requirement that we talked about before. All right, summary here, because we got a little over 10 minutes left. So what happened? To put it all together, because I mentioned these, I sprinkled the changes throughout. The gross asset limit, that gross asset test was $50 million. It is now $75 million and subject to an inflation adjustment starting in 2026. The per issuer cap was the greater of $10 million or 10 times your basis. Now it is $15 million, subject to inflation adjustments. And the 10 times basis cap, and I'll tell you how we get into this, used to be 500 million up until July 4th of this year. The way that you get there is you had a gross asset limit of 50 million. So if you did one of those transactions that I just described to pack your basis, if the fair value was over 50 million at the time, none of it's QSBS. So the goal was to get as close to that $50 million mark as possible, if you could, and then pull the trigger on the conversion. And so the maximum exclusion under the 10X rule would be 500 million. Now, with the $15 million inflation adjusted number, it is 75 million. So you take that gross asset limit and you multiply that by 10, you get the 750 million. I'm sorry, I misspoke. With the gross asset limit at 75 million, the 10 times the 75 million gets to a $750 million, which means the potential benefit of packing is $750 million of gain exclusion if you do it correctly. Although I wouldn't recommend skirting the line of 75 million. The holding period, this was a huge benefit. And I remember distinctly because I had an issue with a client who was 4 years and 10 months into his holding period and got an offer from a public company to buy his stock, and they did not want to move on the corporate transaction. They were not willing to push the closing date back. And so we had this problem with this 5-year cliff effect. So previously, if you held the stock for 4 years and 364 days, then actually it needed to be more than 5 years. So for even 5 years, 0 QSBS gain exclusion. That was a problem because it was starting to cause issues with exit transactions and trying to push off transactions. And it really was inequitable, especially considering the private equity world and VC world, where the exit horizon is usually 3 to 5 years. They're not really looking to hold stock for longer than that. So what we have now under the OBBA is a 3-year, 4-year, and 5-year rule. Again, I mentioned this at the beginning of the presentation. The 3 years, if you hold it for 3 years or more than 3 years, 50%. 4 years is 75%, and 5 or more years is still that 100% gain exclusion. This was something that was in Kustav's proposal and something that we really advocated for when we were up in DC. AMT treatment, prior there was some of the older stock was an AMT preference item, although that went away at some point historically. It is now permanently an excluded AMT item. It is not an AMT preference item going forward. And then the effective date here, it's acquired after July 4th. So hopefully nobody was doing transactions on July 4th and got trapped into that. It doesn't include the date of issuance. This just summarizes everything that we went through: the phased-in approach, the exclusion, the increase over time for holding period, and then the applicable date. We talked about 1223 tacking, so 1223 now comes into play with determining the holding period. To summarize, and let's see here, implications. We talked through all of these. We got rid of the cliff effect, not AMT. So 174, we talked about how that was a big deal. And so what it all boils down to is a lot of planning opportunities here with Section 174, with the increased aggregate gross asset test and the time horizons. It's never been a better time to think about doing a 1202 setup for a qualifying company. And you really need to work with somebody, with your clients who really is well versed in these rules. There are a million traps for the unwary. And I think even more so now, because you're effectively going to have different types of stock for existing corporations that may have been issued at different times that are subject to different rules. So pre July 4th or July 5th issued stock is going to be subject to the old rules. If you had stock that was issued before then, it could be subject to other 50%, 75% limitation rules. Some of it could be AMT preference, some of it could be non-AMT preference. And you really just need to pay attention and track all of that very, very carefully. I think that's all that I have. I think at this point, we wanted to reserve some time at the end of the presentation for questions. So I don't know if, Andrea, if you wanted to open the floor to questions or how you wanted to handle that.
Hey there. So the chat is open for any questions that any of the attendees might have.
I see a Q&A. Okay. Oh, here we go. Mark, can you explain who is qualified for the no tax on tips rule, and can you provide examples?
So it was those who were covered under Section 7 of the Fair Labor Standards Act, which are most public and private sector employees who are paid on an hourly wage basis. So those commissioned, retail commission, not covered. Those elected officials, management, not covered. And so it's not available to them. So it's the bulk of those individuals we think of who are entitled by law to time and a half for hours beyond 40 hours in a work week.
I think they were talking about tips. I heard this.
Oh, on tips.
Yeah, on tips. Yeah.
I'm sorry.
But somebody asked me, I think at the tax section meeting, whether, lawyers could start accepting tips instead of base fees. So, maybe
Right.
just clarify on that.
Yeah, thank you. I thought you said on overtime pay. So no, you didn't. You were right, Adam. So on the tip pay, So again, it's those individuals who are in industries that customarily pay tips as of December 31st, 2024. And Treasury IRS has 90 days from July 4th to list out those industries. So that list hasn't been published yet, but we can expect it soon. And so the starting point for who is qualified will be, those who are in that business. You think of individuals like, bartenders, valet, those are industries that are customarily involving tip income. And tip income is not limited to cash tips. It's 3 categories of payment. It's cash, tips paid by charge, and tips paid through a pooling arrangement. So, for example, at a lot of golf courses, you might have, the folks working the bag room, some of which are out cleaning the clubs when you're done, and they generally share tips with the other folks who are working with them, but who are not client facing, who are, inside arranging the golf carts, things of that nature, right? So that's through a pooling arrangement.
Thanks, Mark. All right, I'm gonna try to rapid fire off answers here. So somebody asked about safe notes. Does it start the holding period? There are a couple of attorneys out there who will give you an opinion that a safe note does start a holding period for 1202. I am not one of them. It does depend on the instrument. You do have to look at it. Even the new Y Combinator instruments that say that it's supposed to be treated as equity, I do think that has a better argument. But those are, sort of, bootstrapped type documents that really, the government's going to look at the substance of it. And because it is a simple agreement for future equity and you don't actually have equity in the company at the time, my view is that it does not start the holding period until you convert the safe note. Next question was, what if there's a $70 million gross assets of the company on June 1st? The answer to that is it's at the time that you issue the stock. And so if, for example, a company hadn't issued the stock yet, and you're talking about an LLC that's taxed as a partnership or an S corporation, and you effectuate the conversion to a C corporation after July 4th, you would qualify. So the answer to that question is yes, as long as it's not a C corporation yet. Any stock that was issued before, if it was at $70 million when the stock was issued, you would have a problem. But if it was at under 50 million when the stock was issued, you'd be fine. QSBS, I get this one a lot. Can a shareholder double his gain by transferring stock to a spouse? So there's a rule, there's a parenthetical that says married filing separately, you cut your gain exclusion in half. And then there's another rule in 1202 that says for purposes of determining future gain, each spouse who filed jointly is treated as having claimed half of that gain exclusion. There are lawyers out there who will give you an opinion that says that because of the statutory language, you can double the gain exclusion. Again, I am not one of those. I think there's an extreme risk, but there's certainly folks who are taking that position. That language was not clarified in the new bill, so there's still a position out there. I just don't think it's a very good one. I will say on that front, I have seen benefits where there's stock transferred pursuant to a divorce. So that's that one. Let's see. Can you get separate taxpayer treatment to stack QSBS exemptions if you have one non-grantor trust and then divide it into multiple trusts at some point prior to the transfer? I think the answer to that, and I may have to punt over to Mark because I don't do a ton of estate and trust work, but as long as they're treated as separate trusts under the non-grantor trust rules, I think you'd be okay. The key here is that you have to have a separate taxpayer. So if it's one trust, if it's treated as one trust for purposes of the non-grantor trust rules, and you're filing one income tax return for that one trust, it's not going to work. If you have separate trusts, then it ought to work, and they can be separate trusts created after the issuance of the stock as long as there's a gifting of the stock to the trust.
Yeah, and Adam, I think you're right on point there. And what I've seen a lot of, for example, though, you want to avoid also, reciprocal trust doctrine treatment. So if, for example, a client has 3 children and there's a pot trust for the 3 children that you later want to separate, you would not create 3 trusts, each trust for all 3 kids. You would have, trust 1 for child 1, trust 2, child 2, trust 3, child 3, and that should work.
Yeah. I see we're at 1 o'clock exactly. I'm certainly willing to stay on and go through some of these other questions in here. We have a bunch more to get through. I'm happy to stay on and do that if you want, Andrea.
I'm just going to give some last minute information, and then whoever wants to stay on can stay on. The course number for those of you that have been attending via telephone is 9224. You can always email me and I'll be happy to email the material for anyone that connected via telephone. We wanted to give our heartfelt thanks to our speakers, Michael, Mark, Steve, and Adam, our sponsor, Glenmede. Thank you for that, Adam, and the attendees that attended today. Each of their presentations on the current developments in tax law was very informative and insightful. So thank you very much. We're also excited to announce that we are working on sharing the key takeaways from this session along with other valuable information in the upcoming edition of our tax bulletin. So we urge all of our attendees to keep an eye on your inbox for the release of the bulletin, and feel free to share it within your network. But most importantly, do not forget to sign up for the next presentations, which are taking place next week already. I'm thinking July is next month, and August. So July 30th will be Federal Tax Procedure Part 1, and August 20th would be Federal Tax Procedure Part 2 with Karen Lapicas. We thank you once again and hope to see you at the next CLE taking place next week. And Adam, feel free to
One more announcement, Andrea.
Yes.
One more announcement, which we said we were going to do and we didn't do, is a shameless plug for our October meeting, which is going to cover these in great detail and plenty of more planning opportunities. I think this is a very exciting time to be a tax lawyer, as was 2017. There are a lot of great planning opportunities, as you can see from all these wonderful provisions that came in. And, definitely think about attending. Andrea and Whitney are going to circulate the information to all of our tax section members about that meeting. I encourage you to register. It's going to be in the JW Marriott in Clearwater in October. I'm the director of that CLE program. If you have any questions, or maybe even if you're interested in presenting, shoot me an email. I dropped it in the chat. So that's my shameless plug.
Thank you, Adam. I appreciate that. We didn't have the flyer yet, so we'll probably circulate it as soon as we have it.
All right. If you want to leave, you can leave. If you want to stay, looks like we got a bunch of 1202 questions here. Oh boy, all 1202 questions. Oh, there's another one for Mark. I'm going to try to get Mark off. Let's see.
Thank you. So the MAGA account.
Children. Did you see that one?
Yeah, it's an opt-in. So it's not until July 4th of 2026 that an individual or their guardian can opt in to open the account. So there's no platform, and there won't be a common platform like 529 plan investing. You'll be able to open it at a bank or a trust company like many of us work with on a regular basis. So, and I'm going to jump. So Adam, I'm going to leave you this in your capable hands, and thank you and Mike and Steve. This was a blast, and I enjoyed being part of this august group.
Likewise, and we really appreciate you, Mark. Mark, yep. You'll be at the meeting too, right, in October?
Yes.
So any questions you have for Mark, I'm sure as things play out, he's going to be doing a lot of research and coming up with a bunch of great planning ideas for your clients. Definitely go up and see Mark in Clearwater. He's gonna give you some great ideas.
I look forward to it.
All right, thanks, Mark.
Thanks.
I'll address some of these other 1202. Let's see here. QSBS, double her gain. Okay, so we did the spouse one. Can you get separate tax treatment for QSBS? Okay, we talked about the trusts. Can a Florida LLC, which upon formation check the box as a C corporation, be a candidate for 1202 treatment? Yes, absolutely. If it's a C corporation for U.S. tax purposes, that stock, assuming it meets the qualified trader business, one of the rules I didn't get too deep into is there are only certain types of businesses that qualify. So unfortunately, lawyers, accountants, doctors. A lot of the work I do is figuring out how to get into the qualified trader business realm. So you need to make sure you meet all these other requirements. It's a very complicated area of law with a very thin body of law underneath it because of all the things that I mentioned about the history of the bill and the history of 1202. So yes, the answer, Paul, to that question is generally yes, as long as you meet the other requirements. The next question, what if existing 1202 Corp goes over 50 million to 60 million in June of 2025 in adjusted base? So forever under the old law, stock issue would not qualify. Correct. Then the new stock issued on July 5th is the 75 million used for all purposes. So the stock issued, so it's the it's measured at the time of issuance, but the way that it works is if you had a previous re-51 contribution, then it's the fair market value. The consensus is it's the fair market value of the date of that contribution that forms the basis for 1202 purposes. So if you were under the 50 million back then, or you were at 60 million and then you issued new stock and you were under 75 million at the time that you issued the new stock, that new stock ought to qualify under the new rule. I haven't really, obviously this is very new law, so we haven't gotten into that yet, that issue, but it's an issue. I do think that you measure the basis at a point in time when the stock was issued. And so in the latter scenario, when it's issued after the effective date of the new legislation, if you look at the aggregate gross assets of the company, and that's based on historical basis, which includes the fair market value at the time that they were contributed, I think you would get there. Okay, next question. Whether a married couple filing jointly can claim the $10-15 million exclusion, or is it limited to 10-15 million per couple? Yeah, this is the same question as before. I'm not comfortable taking the position that a married couple can double their gain exclusion on this. If you want the name of somebody who's willing to write an opinion on that, I can give you that separately offline. Just email me. I always tell my clients, like, I'm not willing to put my bar license on the line, but if somebody else is willing to do it, I'm happy to send them your way. It is a risky position. I don't think the code supports it. I don't think the intent of the statute supports it. I think the parenthetical in the statute makes it pretty clear that that's not what was intended. Next question. How does the packing concept work when there is a limitation on built-in gains becoming 1202 property? Limitation. I'm not sure I understand the question. How does the packing concept work when there is a limitation on built-in gains becoming 1202 property? I'm not sure I understand this question. The way that packing works is you stay outside of the C corporation context until the value of the assets exceeds $1 million per pro rata share per owner. And that way, when you convert, you're outside of the $10 million rule and into the 10 times basis rule. And now, again, that's $1.5 million because it's $15 million of gain exclusion. Phantom stock agreements, also would they not start a holding period? So yes, so this one goes to what is stock for federal income tax purposes. So phantom stock is not stock, right? That's the whole point of it being phantom stock. That would not start a holding period. And I would have the same issue, actually more so of an issue than I have with safe notes on phantom stock agreements. I don't think you could ever treat that as having qualified and being issued under an original issuance. Also note that phantom stock, that's a contractual right. So most likely your client is probably receiving ordinary income when they get paid out on that phantom stock agreement. How are eligible children? Oh, we already talked about that one. Natalie, good hearing from you if you're still on. Yes, I'll send you this slide if I can find it, the one that you're looking for. What if you have $5 million of basis? pre-July 2025 stock and then invest another 10 million in post-July 2025 stock, both at good QSB times, how is the overall QSB gain exclusion calculated? Do you look, so this is a really complicated rule on how it's calculated. I think it's an aggregate test. So you would take your total basis of your stock and multiply it by the 10, and then you can apply it on that ground. The problem is that the stock issued post 2025 is going to be treated as a separate type of stock. And so I haven't really worked through this. It is a good point that you're making, but I think it's something to think about, because one of the ideas is that with packing basis, is that you could make a contribution of property really close to the sale of your business and boost your basis. Whereas, previously, maybe you wouldn't have even been in the 10 times basis rule. So let's say your shareholder founder had IP outside of the business and, a month before the sale contributes the IP to facilitate the transaction, and the IP is where all the value is. There is an argument there that your 10 times basis rule would come into effect based on the value of that contribution at the time that you make the contribution, even though it was later, to determine your 10 times basis limitation. I think those are all the questions. So thank you, everybody. Certainly email me if you have any other questions. I'm happy to chat, and look forward to seeing everybody in October.